attendees to this event organized by PKF Academy and Transfer Pricing University, where we will discuss the new transfer pricing regulations in Malta and the European Union Transfer Pricing Directive. The microphones will be turned off during the conference, but they will be open for a session of questions and answers at the end. Transfer pricing is one of the most important topics for multinational companies at this time. Compliance, documentation requirements, disclosures requisites, and controversy matters have increased over the years. For PKF, it is important to provide solutions to our clients in audit, accounting, business solutions, tax, corporate finance, and of course, transfer pricing. Malta has recently implemented new transfer pricing regulations aimed at aligning with international standards and ensuring fair taxation practices. These regulations require multinational companies operating in Malta to comply with stringent transfer pricing documentation requirements. The new regulations mandate that companies engaging in cross-border transactions must maintain comprehensive transfer pricing documentation to substantiate the arm's-length nature of their intercompany transactions. This documentation should include details of the company's transfer pricing policies, the economic analysis supporting the pricing decisions, and relevant financial information. In addition, companies are required to submit this documentation to the Maltese tax authorities upon request, demonstrating compliance with the arm's length principle and ensuring transparency in their transfer pricing practices. Failure to adhere to these regulations may result in penalties and potential tax adjustments by the Maltese tax authorities. Therefore, it is essential for multinational enterprises operating in Malta to understand and comply with the new transfer pricing regulations to mitigate risk and ensure compliance with local tax laws. I really want to thank the speakers today. Anna Bemuganti, who is a senior economist with the transfer pricing team in the Center of Excellence, and Alexander Natanelov, our PKF transfer pricing pillar leader. Alexander, welcome to this event. The microphone is open for you to speak briefly about the recent developments in the European Union regarding the Transfer Pricing Directive.
Thank you, Jimmy. Good afternoon, everybody. Very happy to be here together with you. I think it's very important development within Malta, introduction of the new documentation. And we just also wanted to inform you about an additional initiative that has been launched, issued a draft EU Transfer Pricing Directive that should be actually in place as of 1st January 2026. Of course, we should wait and see whether it in reality will be in place. However, it could be an important development. You could ask yourself the question, what's new in the directive? And I think I can be quite short in that. I think the directive is very close to the OECD Transfer Pricing Guidelines. However, as you probably know, the OECD Transfer Pricing Guidelines that are a soft law. So it's a soft legislation, and the countries are not obliged to follow it. On the other hand, in the meantime, the most European countries, and actually even worldwide, I could say, have implemented the biggest part of the OECD Transfer Pricing Guidelines in their local legislation. So you can ask the question, what's the added value of this directive? However, I believe that personally, there could be added value. And what could be the added value is that once the guidelines are also in the European legislation, then actually the European courts could rule on certain discussions. And today, all these discussions on TP stay on the local levels most of the time. So this would mean that there would be more certainty and more framework within Europe at least. On the other hand, we need to have unanimity to adapt the directive. So it's a big question whether all the countries will agree with the text of the directive, because in some cases it's not in line with their current local legislation. And it would mean that different countries should adapt their local legislation. So we had already a period where all the countries could submit their comments on the TP draft directive. The deadline for that was February 2024. So now the working group will start to discuss on this topic, and they should find unanimity to adapt the directive. So the expectation is that the text still will be adjusted a bit, or maybe a lot. Wait and see. Maybe regarding the content, very briefly, I think there are a few important elements included in the directive, meaning the definition of the arm's length range, when are the companies related or associated companies, and this kind of information. So quite basic information, but I think it gives a good basis for certainty. So I would say we will keep you posted in case of the future developments. And if you have any more questions in this respect, you can always ask them after the session. And I will give now the word back to Jimmy and Anand to talk more about TP legislation in Malta.
Thank you very much, Alexander, for your words. Now it is a chance to listen to Anand Bemuganti, who will be speaking about the Maltese regulations and the general topics of this session. Anand, the microphone now is open for you. Thank you.
Thanks, Jimmy, and thanks, Alexander, for setting the scene. I think good afternoon to everybody and warm welcome to all for this session. I would quickly go through our content page just to give you an idea what our session is going to be. We will do some introduction to the transfer pricing guidelines in Malta. Then we talk about the cross-border arrangements and what are the material altercations and what are the exclusions for companies for preparing transfer pricing documentation. Then we go ahead with next unilateral TP rulings and alignment. I understand that most of the today topic would be more closer to how the EU regulations aligning with the OECD TP guidelines, and followed by advanced pricing mechanism. And the second half of the presentation would be around introduction to a bit more on the EU Transfer Pricing Directive, and then how the harmonization of EU directive happening to the OECD guidance, or what are the common points of discussion, what are the recent case issues that we have, and then what are the reaction of TP directive from member states, and then finally understanding what are the next steps, and followed by a practical case study in terms of TP controversy that we have seen across the region, especially between the European states and also with the South America or with other regions. So I think this is just going to be the flow of our the whole idea of it. Sarah, can you just go to the next slide, please? So this gives you the brief introduction to the transfer pricing guidelines in Malta. The Ministry of Finance and the Employment officially introduced on November 18, 2022, and then the guidelines published as legal notice 2024 and expanded the scope of these transfer pricing rules as originally enacted. And the transfer pricing rules apply to intercompany arrangements on or off after 1st January 2024. However, the arrangements that were entered into prior to 1st January 2024 will also be subject to the transfer pricing rules if such arrangements are materially altered on or after that date. Here, it's very important that I have seen is what is actually the alteration. That is why we have coming slides. We have made a slide to give you exactly what consists of altercation. So the TP rules are divided into three main parts. If you look at from a verbatim, the first part outlines the core transfer pricing regulations, and the second part introduces the mechanism for formal unilateral transfer pricing rules. And then the third one discusses about the advanced pricing agreements. So I'll be dealing with the first part, and then in the coming slides, Mr. Jimmy would be taking care of the formal unilateral transfer pricing rules and advanced pricing agreements. In terms of the core transfer pricing rules, what we have seen a clear alignment is in terms of methodology. So even the Malta regulations clearly adopts the OECD transfer pricing guidelines, which is chapter 2 of the OECD guidelines, and they follow the 5 methods and also the other methods as accepted in 2.9 section of the OECD guidelines. And also the Malta regulations also give you an opportunity to not only use just one method, you can also use, depends on the situation. For example, if you take a distributor and you're looking at resale price method, which is like just buying and selling at gross margins, but also a Malta distributor also have expenses from an operating expenses perspective, that he receives services from abroad or he received other services there. We can also supplement our analysis not only from a gross level, but also at a net level using a transactional net margin method. And we can look at the net level to see whether they are at arm's length. So that guidance is quite clear. And also the low value added intra-group services. And Malta has again aligned with respect to the OECD guidelines and European Union Joint Transfer Pricing Forum guidelines. That is again going with the 5%. Also, we always have questions about what is the intra-group services and which are not the main revenue generating activities. Those administrative support services, like for example, accounting, legal, IT support, and these transactions, if there are cross-border, then yes, you can use these guidelines as a safeguard and then use the 5% on your markup on your costs. So this is just to give you a bit of introduction on what are the alignment on the transfer pricing guidelines for you. On the second slide, Sarah, next slide, please. So this is just to give you more clearance on the part where the arrangements. So the new guidance provides that the fiscal years starting on or after 1st January 27, arrangements initiated before 1st January 24 that have not been materially altered on or after that, the date will be also included within the scope of the rules, hence imposing a 3-year time limit on the grandfathering provision. The guidelines clearly clarify that determining whether an arrangement has been materially altered requires a case-by-case basis. I think that's one of the very important things to understand when you're looking from year on year. What are the changes, functionally changes that you can clearly see? Also, what should be considered in terms of whether there's a clear change in the substance, whether there's a reference to the functions performed or assets used or risk assumed by each of the parties of the arrangement. Specifically, the guidelines provide the changes to the considerations, the rights, and the obligations of the parties, and the duration. I think that's one important aspect that we need to look at it. In the next slide, we further dwelling deeper into the aspect what should not be regarded as a material alteration, and then what should be regarded as a material alteration. In terms of not regarded, what we have seen is the minor, any administrative adjustments like the entity's contact details or representative or the payment transfers, and or any unilateral changes in terms of internal operations such as hiring or changes in terms of employees, the number of people working on it, and then any other changes related to the specific changes related in terms of obligations arising out of arrangement. For example, there's a merger that happened, or there is something new that happened. I think these are the aspects that we need to look at, which cannot be regarded, but what needs to be regarded is the ones material to the transaction. For example, you're looking at the practicality of the modification of the method itself. So from initially have used certain different method cup, and then you are suddenly changing to a different method. So it's always good to have is supporting documentation to justify why there is a change in method, and also if there is any change in remuneration policy or any profit level indicator in terms of whether we are looking at from a cost perspective or whether you're looking at from a revenue perspective, or in terms of a contract, if there is a significant change in terms of a duration, is there any impact of short-term contract or is there impact on the long term? And also on the volumes, is there any discount issues that you can have? So I think altering the transaction itself in terms of the remuneration and in terms of how you can modify is what we need to clearly look at it. And finally, on the next slide. So this is where we introduce, and I think again, more or less, the Malta Tax Authority has gone ahead and then picked aligning with in terms of what is considered as cross-border arrangement with OECD. And as the rules are only applicable to cross-border arrangements, there is no domestic impact there. So if you have two Malta entities and one is doing manufacturing and then you're selling to a distributor, one more entity in Malta, then we need to only if you have a cross-border outside Malta, this impact is there. And there is a threshold. Generally, there's a 75% on the voting rights and directly or indirectly or a participation more than 75%. But when it comes to CBCR country by country reporting obligations, the threshold has further lowered to more than 50% of the constituted entity when you wanted to prepare a CBCR reporting or CBCR notification. And then these arrangements are between resident entity and the non-resident, and also in terms of a permanent establishment situated outside Malta to which the arrangement is effectively connected, and any other income or gains arising in Malta, especially is the one that we need to look at it. So these are the most important aspects that we need to look at it. And then can you move on to the next slide? So in terms of what is considered in terms of exclusion activities and also like a threshold, I would say, and also the de minimis requirement, the small and medium enterprises are exempted from the rules as they meet the criteria. They have a specific criteria on the Commission regulation. The rules are applicable to enterprises as large as do not meet small thresholds. The criteria is classified like this in 3 categories. The first category is micro, small, and medium-sized enterprises, which employ fewer than 250 people, which has an annual turnover not exceeding euro 50 million, and or an annual balance sheet not exceeding euro 43 million. And the second category is considered under the SME category. Further, they have provided a small enterprise is defined as an enterprise which employs fewer than 50 people, and the turnover or annual balance sheet does not exceed 10 million. And the third and final category is a micro enterprise defined as fewer than 10 people and the annual turnover is less than 2 million. So if any organizations fit into these are classified under SME as part of the employee count or as part of their revenue, I think that is where there is an exemption for preparing the transfer pricing documentation. Also, on a general whole, they have clearly given the direction of revenue nature forming a part of cross-border arrangement that does not cross 6 million, and any capital investments nature forming part of a cross-border arrangement that does not exceed 20 million. I think with this, we have set a stage for you to understand what are the recent changes and recent requirements in terms of what aligns with the OECD. I will leave the second part and the third part of the guidance for Jimmy to go ahead. Next slide for you, Jimmy.
Thank you very much, Anand. Yes, transfer pricing adjustments initiated by jurisdictions abroad refer to situations where tax authorities in foreign countries, for example, they decide to audit an intercompany transaction and then deem the pricing to be inconsistent with the arm's length principle. This can result in adjustments to the taxable income of entities involved in the transactions, leading the situation to a potential additional tax liabilities or refunds depending on the nature of the adjustment. In response to such situations, tax authorities are often allowed to issue unilateral transfer pricing rulings based on strong documentation and explanation to support intercompany pricing decisions. Similarly, downward adjustments performed by a tax resident, in this case in Malta, involve situations where the Maltese entity voluntarily revises its transfer pricing prices to align, for example, with the arm's length principle. This could occur during a transfer pricing audit or as a proactive measure also to mitigate the risk of transfer pricing disputes with the tax authorities. In these cases as well, taxpayers are typically permitted to issue also unilateral transfer pricing decisions or transfer pricing documentation demonstrating the rationale behind the adjustments and ensuring transparency with the tax authorities. In both cases, the tax authorities may be able to issue a transfer pricing ruling subject to the fact that the intercompany transactions are based on the arm's length principle, to avoid double taxation and subject also to a bilateral agreement. As for the alignment with the OECD guidelines, as you know, the OECD guidelines provide a very complete framework for transfer pricing, outlining various methods to determine the arm's length prices for transactions between related entities. Typical methods in order of priority are the comparable and control price method, the resale price method, the cost plus method, and the transactional net margin method, or TNMM, and the profit split method. These methods are widely recognized internationally, and they are accepted as a standard practice for transfer pricing analysis. They allow taxpayers to assess the appropriateness of the intercompany transactions by comparing it to similar transactions between unrelated entities. In Malta, all these methods are accepted and they are endorsed by the local transfer pricing regulations, aligning with international standards set forth by the OECD. Taxpayers operating in Malta are expected to use these methods to determine the arm's length prices for their intercompany transactions and to maintain documentation supporting their transfer pricing policies in accordance with the Maltese regulations. Of course, they can also use other methods as stated in the OECD guidelines, but the most important methods were described before. Next slide, please. Mexico is probably the country that has issued more APAs in the world. Advanced pricing agreements or advanced pricing arrangements between taxpayers and tax authorities establish transfer pricing methodologies for future transactions. These agreements provide clarity and predictability by determining acceptable transfer pricing methods and pricing levels in advance, typically for a specified period of time. In Malta, in this case, is for up to 5 years. The primary objective of an APA is to mitigate transfer pricing disputes and provide legal certainty to taxpayers. By proactively agreeing on transfer pricing methodologies with tax authorities, taxpayers can reduce the risk of audits, assessments, and potential penalties. APAs help to streamline compliance efforts and minimize compliance costs, and also promote a cooperative relationship between taxpayers and tax authorities. The importance of the APAs, as I said before, is providing legal certainty and also legalize in their ability to offer binding agreements that are respected by tax authorities. Maltese regulations and tax authorities also offer the possibility to issue unilateral, bilateral, and multilateral APAs. This provides taxpayers with additional options to secure transfer pricing agreements that are mutually beneficial and promote certainty in cross-border transactions. Overall, APAs play a crucial role in promoting transparency, consistency, and fairness in transfer pricing practices. In the next slide, in the next part, we will speak briefly now and in more detail, about the European Union Transfer Pricing Directive. Anand, the microphone is open for you. Thank you.
Thank you. Sorry, there's an issue with my microphone. I hope everybody can hear me. So I understand already we have Jimmy and Alexander gave a introductory understanding of what is a EU Transfer Pricing Directive, and then what is the issues about it, and then how it's gonna work. But what we're gonna go in this presentation in the next 2 slides is actually understanding what are the goals of this TP directive, and also how these TP directives can be harmonized with the OECD guidelines. I think let's go to the first slide. So, I mean, we have seen already the information on how the European Commission have started on 2023, and then the Member State Implementation Directive by December 31st, 2025, with a proposed application starting from Jan 1st, 2026. And then we need a unanimous adoption in the European Council as per the Article 115 of the Treaty for the functioning of the European Union to pass this resolution. But my perspective in terms of today, what we want to discuss is what are the stated goals. First is increased tax certainty. Second is reduced compliance cost. And the third, mitigating the risk of double taxation and litigation for cross-border intragroup transaction within the EU region. The rationale for this proposal is born from the fact that although most EU member states are members of the OECD, the status, role, and the interpretation of the OECD guidelines differ from member states, and the provisions described in the TP directive must be implemented. So that gives, in terms of clarity, and also how the arm's length principle is introduced among the states, because we understand in our experience, certain countries use intra-quartile range, certain countries use full range, and sometimes specifics into the methodology, they look at from a different perspective. So when you have different rules for different states, and when you look at from a bipartisan nature, it's always difficult to find, and having this unique, in terms of having this regulation more harmonized, that so that every country have a clarity, is what the next step that what the EU Directive Transfer Pricing Directive is for. And can we go to the next slide? So we have highlighted certainly important points here for us just to understand how this harmonization with OECD TP guidelines is happening. I think the most significant impact of TP directive on the member state is the incorporation of the arm's length principle in the EU law. As Alexander mentioned before, OECD is not binding on countries. It's more of a guide for the taxpayers to look at and then in terms of how their pricing is structured across the cross borders, but having them in the law is where this EU directive is going to. And the second, recently we have a case, Fiat Chrysler Finance Europe state aid case, where the Commission applied the ALP that deviates from one defined in the Luxembourg law by taking into the account only on the OECD guidelines. And according to the Court of Justice of European Union, that this considered as a fictitious and erroneous framework for the assessment of the state aid. So when you have the member states in the European Union have their specific idea or specific policy or the way the agreements or the way the rules are drafted in terms of how ALP should affect the transaction. So that's where it's important. And this is one of the cases example, even though the OECD worked from the other perspective, but from a Luxembourg perspective, it didn't work. And there is no threshold linked to the rules. However, a common definition of what should be considered as a controlled company has been included in the directive of Article 5. Furthermore, the directive renders the latest version of the OECD guidelines legally binding on the member states. Considering that the OECD guidelines are updated continuously, further updates of these guidelines must be accepted through approvals in the framework of OECD Committee on Physical Affairs. Another important point is also how we are interpreting the arm's length pricing in terms of comparability analysis. According to the directive, the taxable result of a multinational entity shall not be adjusted if it falls within the interquartile range. I think that is where also quite important in terms of intra-group arrangements. So when there's a situation where it can be a 5% to 7% from a benchmarking perspective in the European region, but one country doesn't recognize the methodology of it or the cost allocation of it, how to justify that is what this directive about harmonizing in terms of the OECD to get the standard on the both spectrum of taxpayers from different countries and from with respect to their local laws. The next slide, please. So the next slide actually talks about reaction from the member states, and Mr. Jimmy Cruz will be taking this slide.
Thank you, Anand. Yes. Member states have, in general, they have shown limited response to the TP directive, with the majority of attention directed towards the Business in Europe framework for income taxation, or the so-called BEFIT directive. The Swedish government, for example, argues that discrepancies in member states' application of the arm's length principle are overstated, suggesting that the disputes often stem from differing case assessments rather than divergent use of the OECD guidelines. In a significant development, on November 14, 2023, the European Parliament put forth a draft resolution on the Transfer Pricing Directive, which includes a provision for a sunset clause, aiming to gradually phase out the arm's length principle. Instead, it proposed adopting a tax allocation mechanism reminiscent of previous initiative. Under the proposed sunset clause, the TP directive would cease to apply to groups governed by the BEFIT regulation by 2035 and to all multinational groups operating within the European Union, excluding transactions involving third countries by 2040. So this is a situation generally talking about the member states' reactions and organizations. In next slide, we will talk briefly about the potential, and the next step, for the TP directive, and this will be taken over by Anand. Please go ahead.
Thanks, Jimmy. I think, as Alexander mentioned in the start, the final date for member states to provide their comments was already passed in 16 February 2024. And since several countries have objected to the proposals, change can be expected in terms of how the directive is going to be. And also, for the TP directive to be adopted, a unanimous approval is required from all member states. So following the feedback from the members of the Economic and Monetary Affairs, it's also important to look at how the adoption happens into a definitive act, and also how the actually member states embrace these guidelines into their local legislations. So overall, harmonization in TP could be positive, but given the differences that exist between the member states and the focus they have on protecting their database, a great deal of uncertainty still remains around the likelihood of how this TP directive becomes a reality. I think it's a wait and watch situation, and then we expect to have some guidance at least by end of the year, and then we are very happy to update you on how, for a multinationals operating, especially headquartered in the EU, and then have operations across the European Union. Hopefully, there'll be a certain certainty in terms of the arm's length principle. The next slide, please. So what we wanted to end this whole session is to give you a flavor of the guidelines, and then followed by the EU directive, and also on the practicality, how a case law in terms of a APA and MAP between Mexico and Germany. And this will be taken by Jimmy Cruz.
Thank you, Anand. Yes, next slide, please. So we can talk for years about regulations, but nothing is more important than practical issues. So you can see now on the screen a practical case. It refers to a German pharmaceutical corporation that established a distribution subsidiary in Mexico to capitalize, of course, the importance of the Mexican market for its products in the local region. This strategic move led to a substantial increase in the subsidiary's operational profits, driven by robust market demand and a stable expenses structure. In response to this positive trend, the German parent company decided to adjust the transfer pricing upwards by more than 10%. Then this adjustment had the objective to ensure that the Mexican subsidiary maintained an arm's length gross margin, but also reflecting the evolving dynamics of the market, in this case of the Mexican market. In light of this transfer pricing adjustment, the Mexican distributor decided to secure an advanced pricing agreement using the modified resale price method. This approach sought to address disparities in expense levels between the tested party, in this case, the distributor company, and the comparable entities. The transfer pricing analysis used to the German entity focus on holding that company, all the intangible assets, and of course, all the know-how and the manufacturing activities. Subsequently, the APA request was formally submitted to the Mexican tax authorities, triggering also the initiation of a mutual agreement procedure with their German counterparts. This procedural pathway involves bilateral negotiations between the tax authorities of both jurisdictions, with the goal of resolving transfer pricing discrepancies and achieving, of course, a mutually acceptable resolution. The pursuit of an APA and the ensuing of a mutual agreement procedure underscores the commitment of both German parent company and the Mexican distributor to ensure compliance with the transfer pricing regulations while fostering a harmonious and mutually beneficial business relationship. During the process, you may probably wonder how we started and how we ended. During the process, we first gather all the necessary documentation, such as financial statements, transfer pricing reports, functional info, and also information about the risks assumed in every jurisdiction to get a clear grasp of the situation. Once we had all the numbers in front of us, we dove deep into the analysis made. Then we scrutinized the transfer pricing adjustment, aiming to understand why the operating profits of the Mexican distributor has spiked and whether the German parent company's adjustment was justified. With our analysis complete, we moved on to the next phase. We initiated a formal request for a mutual agreement procedure, MAP, between Mexico and Germany. Then we outlined our case, emphasizing our commitment to resolving the issue through that diplomatic channels. From there, it was time for negotiations. Prior slide, please, back. From there, it was time for negotiations. We sat down with representatives from both tax authorities, and we engaged in constructive negotiations. Armed with solid arguments and evidence, because during this process, you need to always support your arguments with good calculations and also with good evidence, right? We advanced for a resolution that would be mutually beneficial. After some back and forth, sometimes negotiations lasted for weeks, and both tax authorities were looking for their benefit. In the end, we successfully reached an agreement that satisfied all parties involved. Then we documented the terms of the agreement thoroughly, ensuring clarity and also compliance with regulatory standards. With the agreement in place, we shifted our focus on implementation and compliance. And then we also took proactive measures to ensure that the new transfer pricing arrangement was executed seamlessly, maintaining meticulous records along the way. As we wrap up the process, we shifted our focus to implementation and compliance. We took proactive measures to ensure that the new transfer pricing arrangement was executed seamlessly, maintaining meticulous records along the way. In the end, our collaborative efforts and strategic approach enabled us to navigate the complexities of transfer pricing with confidence and integrity. It was a testament to our commitment of excellence in business operations. So this is a practical case, and then we will have the session open and the microphones for the audience in case, yes, you may have any comments or questions, and also for a questions and answers. Thank you very much.
Jimmy, we already have one question actually from one of the people. So I just thought I would just ask you that. What are the practical issues taxpayers can incur while preparing a first-time transfer pricing documentation?
Yes. Well, one of the most important issues is that we need to take care of the functions. Of course, we need to analyze in detail various factors. The most important one is, of course, to understand the position of the tested party or of the company in the supply chain. And we also need to know what are the value drivers of the operations with intercompany transactions. So I will put an example, okay? So many times we tend to confuse functions and operations of the whole company with the value adding and the functions and operations of the intercompany transaction. So we need to be very careful because they may tend to very different and opposite results. So I think understanding correctly not only the company, but also the transaction itself is very important because this is part of the comparability analysis, and it is very important to get a clear idea of the intercompany pricing for every intercompany transaction.
Thanks, Jimmy. Any other questions? Right, we just
yes, I
received
think
something.
we have another question.
Approved AP.
Yeah, maybe this one you may probably want to take over. What are the low value added services and what kind of documentation is needed to support them?
Thanks, Jimmy. See, low value adders are typically refers to those services that do not significantly contribute to the creation of value, or in terms of this is not a main generating activity, but still there is a benefit test that requires to understand why these services are rendered. If it can be IT, it can be HR, or it can be any support services. So what needs to be looked at is how we are actually, any activity in terms of a benefit, if you are able to pay that to a third party, then also that means that it is okay from a transfer pricing perspective to pay to a related party too. So understanding of that cost, how it's generated and how much is paid, having that cost allocation, and also given the guidance that we have, to the safe harbor of 5% from both from the OECD guidelines and also from the European Transfer Pricing Forum guidelines that we have. I think the 5% is where you can maintain, and then of course all the supporting documents needs to be maintained. Jimmy, there's one question I can see in the list. They are all from experience. The approved APAs, is there a method preferred by any specific transfer pricing method for APAs preferred by tax authorities?
Well, I would say it really depends. In the beginning, I said that Mexico is probably the country with more APAs in the planet, but because we have a special regime for contract manufacturers operating in Mexico, especially with the US and Canada. And so in the past, they were all required to request and secure an APA. So I think APAs may probably be like an audit, like an advanced audit for the taxpayer. And they sometimes in the process, the tax authorities may not get what they want. So risky situations, or you think that they will be or they will pose risk situations to the taxpayers, I believe that it's better not to secure, not to request an APA. But if you think you can win the negotiation and you can support the taxpayer's position, then from the taxpayer's standpoint, then I would suggest to request an APA. To be honest with you, my impression is that tax authorities, they don't really like negotiating APAs because they believe they can establish some precedents that may be not so beneficial for them. But negotiations are hard, believe me. It's not easy to negotiate with tax authorities. And in the mutual agreement procedure landscape, sometimes negotiations are even more difficult because tax authorities sometimes they don't have the incentive to even take the phone, okay, to start negotiations with another tax jurisdiction, especially when they are going to lose part of their taxes. So that's my general
Jimmy,
comment.
if I can add something, Jimmy.
Sure.
Because the question is like, what methodology is most preferable? I think.
Exactly. Yes. Thank you.
Yeah, Diana, from my experience, it is like most preferable is maybe difficult to answer, but I think the one that you can or the tax authorities can discuss less on is for me the CUP methodology, so comparable uncontrolled price methodology, because there, if you really have a good CUP, it's very difficult for them to reject that. In all other methodologies, for me, there is always some space and a gray zone where they can play with comparables. They look at your benchmark, they say these are, I mean, you can always adapt it in one or another direction. So if you say what is the most, let's say, certain or gives you more certainty in your outcome, I would say it would be the CUP. If it's the most preferable, I'm not sure, because that gives the authorities less margin to negotiate with you. You know, if you have a CUP methodology, that's the price, and there is a really difficult to negotiate about it. And they somehow, at least from Belgian point of view, if I share my experience with our negotiations, it's very budget driven, and they always try to decrease the advantage for the taxpayer, for example. And that's why they don't like to have CUPs.
Yes, I agree. Yes. Good point. Very, very good point.
Thank you, Jimmy, and thank you, Alexander. I think we are at the fag end of a 1 hour, I would say. And if there are any further questions, I mean, you can reach out to us, and then we can specifically answer after our presentation.
I think we had one microphone open, so they were trying to speak at the same time. So please go ahead. Someone. Okay. So thank you very much. PKF Mexico has established a center of excellence where we provide tailored solutions for companies in the 5 regions, from planning to documentation. And we also prepare transfer pricing returns, and we help in resolutions and in controversy matters. At the same time, Transfer Pricing University is dedicated to offer comprehensive courses in transfer pricing, catering to individuals at every level of expertise. A big thank you to all of you who joined us for this PKF webinar on insights on new transfer pricing rules in Malta and European Union Transfer Pricing Directive. Your participation and engagement are truly appreciated. It is fantastic to have attendees from different regions and countries come together to discuss such an important topic in the business world. I hope you found the discussion insightful and that you gained some valuable takeaways to apply with your organization. Remember, if you have any questions or need further assistance, our team and also Alexander, our global transfer pricing team, and the global pillar team of PKF will be always here to help. Thanks again for being part of this webinar, and we look forward to connect with you again in future events. Thank you very much.